Have you ever wondered how certain investors seem to have an uncanny knack for being early to a market shift? Now, picture this being confident enough to buy Bitcoin when it's just plunged by 50% to $3,000 and then watching it skyrocket to $69,000 over the coming year. It's as though these investors have a sixth sense, a way to nudge the market's hand in their favor. But here's the secret: it's not about serendipity or random bets on the future. No, it's about recognizing the subtle yet powerful signs of a financial regime on the brink of evolution. And right now, we're on the threshold of a monumental shift in crypto. And in today's video, we'll show you how to read the signs and become one of the lucky few who doesn't just witness history, but makes it. And what we're talking about today includes why you will stop looking at the Fed in 2024, what options market volatility says about the next bull run, and even clues that may suggest the regime change happened months ago. Join Ben Lilly, JJ, Ray, and Cody as we decode the blueprint to thriving in the new era of crypto. Now, Ben, I want to start with you. It feels like we just can't stop talking about every word from Jay Powell and the rest of the Fed, and it appears you think this is all about to change. I want to hear why.
It might be hopeful thinking or wishful thinking because I'm getting a little bit tired of it as well. Trying to read between the lines, trying to find out what the conversations are that's happening around Jay Powell, and I'm ready for it likely as much as everybody else. And especially when it comes to crypto, a market where our eyes were not focused on Jerome Powell and all those FOMC meetings, and what's the probability that a rate hike might take place, and what is this governor? Is he being extra hawkish this week or dovish, or was it just heartburn? I don't know, but I think I could speak for everybody here that we're getting a little tired of it. And when it comes to 2024, I do think we're finally going to be able to take a step back and have less attention drawn to what's going on in that ivory tower.
I mean, I can't agree more. I mean, in crypto, a week feels like a year, and we've spent an entire year talking about Jerome Powell, which just feels like decades at this point. So, yeah, unpack this. Why do you think it's going to change? Because I think there's a lot of people in the macro environment that feel like it's not going to change for the next decade. We're going to have to continue to look at Jay Powell. What's your reasoning for why it is going to change?
Sure. Yeah. And it starts really, we can look back to 2020 when we just saw a tsunami of money coming in. So QE was off to the races, and there's plenty of papers on this that talks about how when the Federal Reserve does QE, the market becomes highly correlated. And so that means all the assets are essentially moving together in tandem, and it's harder to find good diversification. It's hard to find uncorrelated assets. It's hard to really essentially pick assets that are outperforming the rest of the pack because everything starts to move in tandem. And in 2022 and 2023, we've seen a lot of rate hikes. And while it's not QE, it's essentially all eyes are still on the Fed and what is happening there. And all the assets that we've really been tracking across all these different markets have also been moving in tandem. So you can apply that same logic to what was going on for the past couple of years. And I have a chart here from January 2023. I took a snapshot of this back in the day. I think at the time I wrote an essay discussing what these expectations were and how much weight we can put in them. Long story short, what this chart or this table really shows is what is the market's thinking in terms of when these rate increases will pause and perhaps reverse. And I use these red boxes to indicate, this is where the federal funds rate is today. We're talking right now in November. So we're at 525 to 550. And this was back in January. We are up there and nobody really expected that, right? We see 0% essentially across the board, and we go to, when we in November, and 4.4% of the market expected rates to be where they're at today. So a lot of the market was wrong.
Mm-hmm.
And in terms of when these rates started to peak, that was in July, which is that horizontal red box. And so we can see that the rates have been higher for longer, just as Jerome has been saying for the past couple of years. And as far as what this means going forward, I have a second chart that really details what to expect. And again, this is the market. We just showcase that historically they're not that accurate.
Yeah, I was going to say, looking at the last chart, how much faith can we put in this one, right?
It's very true. And so I try to lean towards essentially the market being wrong. And so when I look at these boxes, I almost want to think about, so the light blue here, what does that indicate? That's where the bulk of the market is expecting rates to be. And as those blue boxes move from the right-hand side to the left-hand side, that's the market thinking that rates will be cut moving forward, with the dates on the left-hand side indicating essentially what those rates and the probability in terms of timing and all that. So if we try to expect the market to be wrong, similar to how they were wrong for 2023, we can almost point to the yellow here. And so highlight these boxes. This is my own internal thinking. When's this first rate cut perhaps going to happen? It looks like it could happen around early Q3, late Q2. And for Q1 and Q2, we sort of might just stay where we're at. And so it's going to get a little boring in terms of all these press conferences and all these federal governor speeches and engagements that get tracked and everybody trying to decode what everybody's saying. And I think that's a nice relief, at least for the next 6 months.
So it's not as if you're arguing that we're just going to see this massive drop and massive liquidity being unleashed. It's more that people are just going to stop paying attention because it's going to take a while for them to unwind some of this activity.
It does, but I think it's more about correlation, right? When the Fed is really using a heavy hand in the market, assets become heavily correlated, and QE was insane. Right? We've never seen anything like that. They were trying to front run everything in terms of the market because 2007 and 2008 taught us that the Fed did not act quick enough and enough. And so this time around, they went ahead and acted as quickly as they possibly could and likely overreacted. And of course, those are a lot of the inflation issues that we see today. But the point being is when they went ahead and raised the rates, that was a heavy hand approach to the market. And that's why we saw a lot of correlation across the board. Now, with their hand essentially getting out of the market for a little bit, less than before, they're still heavily involved, but not as to the extent that they would be for the past few years. This allows assets to essentially go find their own direction, if you will, and have that correlation come down. And so now we almost have a environment where assets that should perform, or businesses, if you're in the equities market, that should be performing, have good balance sheets, this becomes a stock pickers type of market or alternative asset picking type of market.
Okay, so the Fed is going to back off, give the market more room for it to do what it needs to do, which is to find the actual clearing price for these assets. Explain for the audience how this relates back to crypto, because we just took it from a full macro level. Let's take it back to a crypto level.
Yeah, so really what I'm trying to state here is this is essentially for, we're going into 2024. This is a markedly different, essentially, regime, if you will, for the past almost 4 years. This is almost a first in a long time. Now, what does it really mean for crypto? I mentioned that the correlation is going to be changing. And when it comes to Bitcoin, this is the bellwether asset for crypto. The way that it goes, the market's going to go. Now, as far as how other currencies within crypto are going to move, it's all relative really to Bitcoin and to a very small extent Ethereum. But the timing is going to be uncanny. And that's what really has me excited going into 2024. I mentioned the Fed is going to have less involvement in the markets and take up a lot of mental space. And the halving for Bitcoin, so this is the other chart that I have here today. The halving for Bitcoin is ready for April 2024. if we go ahead and look at all the halvings to date, and we check out how price on a weekly chart for Bitcoin has acted relative to its 200-day moving average, it doesn't close below that 200-day moving average until its new all-time high is in. And that's not like, oh, it happens 90% of the time or 80% of the time. This happens 100% of the time. So that's a great strike rate. And so if we're going to have an environment where assets can essentially move in a less correlated manner, and you got the halving coming up, the timing is great. And so Bitcoin is going to essentially have its reins removed. It can finally run and really showcase what it can do.
At the same time, as we all know, there's a lot of discussion about ETFs because there could be brand new sources of liquidity that are available at the timing that would actually map to the timing that you're discussing here.
Yeah, I mean, as far as an ETF when it comes to Bitcoin, that's just more kindling into the fire. This is an environment that allows Bitcoin to run at the speed that it wants to run. And if an ETF also happens around the same time frame, that's just gives it more upside potential. That should get a lot of investors excited. It can change the sentiment on a dime. It can change mass media perception of crypto at large, and that's a big sentiment change as well. Like, it can make crypto legitimate in mainstream media, which is something we haven't seen in a very long time, right? And that, if we're trying to talk about big overarching changes in the market, this whole allowance of having Bitcoin become uncorrelated to the rest of the market, paired up with your ETF news, and now we're looking at kind of Bitcoin as a whole becoming a very legitimate asset that should be in everybody's portfolio. That's a huge change. I mean, I've been in the space for almost a decade now, and I don't think I would have expected it to happen with such great timing as we're seeing right now.
So maybe it is a little bit of serendipity. All right. You're absolutely right. That is a massive change. I don't think people quite understand, because most people, when they're thinking about the Fed, they're just focused on the liquidity. What you're saying more about the correlation and the fact that as the Fed pulls back from the role in the economy, you can see different clearing prices, as you said, taking the reins off of Bitcoin, a massive change in the market, and potentially coupled with an ETF, so new sources of liquidity. Anything else you want to add before we start getting a little bit deeper into the crypto market?
No, I'm excited to hear what the rest of the guys have to say. I mean, it really feels like the whole market is changing and pivoting, and I have friends and family members starting to ask me about crypto again. So it really does feel like something's afoot here, but I'm very curious to know what JJ and Ray and Cody have to say today.
Absolutely. All right. Well, thanks, Ben. For all those out there, some of these topics we've touched on before, but this one, I think the correlation is something that we haven't before. But if you want to hear more information like this, I definitely suggest you like and subscribe to the channel, where we're providing this kind of information on a weekly basis. And you've got a lot of videos you could go through and a lot more to come. So I would definitely do that today. But JJ, I want to bring it over to you. As the man that we're constantly asking about more of the market dynamics specific to crypto, where oftentimes you're bringing in information around options markets, volatility. I think you're looking to ask the question, what does volatility look like as we go forward? Is there a market regime change happening right now?
Right. So the main thing that I look at is the options market. That's one of my favorite places to find alpha, right? For all the reasons we've been touching on the past few weeks. You just have a large institutional presence there. So kind of these moves tend to manifest themselves in options markets prior to the rest of the market. The way we're speaking to that gamma squeeze, and it was kind of the stars were pointing to it. And obviously that market was positioned well ahead of the move up. And that's kind of a consistent theme in options, is you tend to see these moves hint themselves there.
I think you call them something like fingerprints. You could see the fingerprints that were happening in the market long before it actually happened, right?
Yep. It's like tracking a Sasquatch, right? You're just following the footprints wherever it may lead you.
I was thinking a little bit more like Sherlock Holmes, perhaps, but I like Sasquatch. We can go with that. Maybe that should be the thumbnail. All right,
I like the Sasquatch because it's kind of you're chasing whales, right? Like giants. You're not trying.
Oh, there you go. Yeah. There you go. I like it.
Just stay out of their way. Just follow behind them, and you'll be all right. So what we've seen, though, in terms of that, is volatility's obviously jumped up massively since that gamma squeeze. And that's because everybody who was on the wrong side of that was short volatility. And they were shorting what essentially was a very dry market in volatility for the past year and a half, 18 months or so. Ever since we saw that collapse of Luna, volatility just kind of fell off a peak. We see it here on the Bitcoin historical volatility index on BitMEX.
And JJ, just for the audience, can you just explain exactly what we're looking at on this chart?
Yeah, so what this measures is just kind of Bitcoin's daily movements within a given range, and they kind of apply a score to it. All sorts of, it's like a big math equation, right? But it spits out a score. The higher it is, the more Bitcoin is likely to move in wild ranges. The lower the score there, then the lower the daily moves are going to be, right? So that's when it's just kind of chopping back and forth within 1,000-point range. Nothing's really happening. Kind of what we saw for the majority of the bear market is you have very low volatility. There's not a whole lot of liquidity in the market. Price isn't moving around the way it does, say, in 2020 and especially 2021, right?
Mm-hmm.
And when you look at this chart, you could see throughout the course of 2020 and 2021, it was at very high levels. So Bitcoin was like a 100 vol asset. It was typically trading around like 50 to 120 in the upper end of that range. And then it just collapsed. It fell from about 60 to under 20 and bumped up a little bit after the SVB collapse in March, but there wasn't a whole lot of volatility. Like there was no follow through. What we saw then is people stepped in. Option sellers were like, okay, Bitcoin's already doubled. It's only March. They started selling out of the money calls, and that trade was paying off. They were just collecting that premium, selling those calls. They were expiring worthless, and they were keeping it all. It was a very profitable trade for a long time. But the key here, and what we see the regime changes, is in that that setup wasn't unique, right? Like all year long, there's people selling out of the money options. What changed to make them get squeezed now? And this is kind of like an inflection point in markets. When you finally see that get squeezed, it may signal that the trend is now shifted and now people want to be long volatility. So as where prior everybody was shorting volatility, anytime it spikes up, you sell the rip, you go to options, you sell a 40K call for way more than's realistic, right? Like when there's FOMO, that increases volatility, and they were taking advantage of that to sell options. And now it seems like people are trying to position themselves to be long options. So as we spoke about last week, like after that gamma squeeze, they didn't just take profit, they rolled their profits forward. They took that money and they bought more options with it, betting on further volatility in the future. So this is kind of the main shift that we're viewing there.
Is that okay? So the main shift coming from the largest players is that they're starting to move those options up further on the options chain, if you will, to take it to a higher level in the marketplace. So are you expecting then this volatility to be coming back now? What do you expect is the next thing, and how is that driven by the largest players in the market? Because they're typically giving a strong indication of where we think the market's going to go next.
So it seems they want exposure to volatility in any event, right? Like that's not necessarily even directional. Like you can be long volatility, you can long the short side and the long side, but they just want to be in possession of volatility rather than shorting it. And we really see this on the IV term structure chart here. And that just shows how much it jumped. You kind of see it stagnating below 50. And then all of a sudden we had that big squeeze and it shot up above 60, almost doubled for at the money volatility after that squeeze. So that just kind of shows how underexposed the market was to volatility due to all of those effects we're saying. The market was just so boring for so long that you could just sell it. And then all of a sudden it breaks out. And this is almost an asset in and of itself, right? Like the same way Bitcoin charts break out, we can see breakouts in volatility. And that can lead to a bull market in volatility where price is moving wildly for long periods of time. And that typically will coincide with higher prices as well, right? Like you have price expansions and then price comes and back tests it. And it just creates a whole lot of movement in a very wide range, which is ultimately the definition of volatility.
So JJ, help me out for someone who's looking at this and wondering if we just have another fake out, right? This is just another bear market fake out that we're going to see the numbers come back down. What's telling you that this is a regime change that's actually happening? You're starting to see the confluence versus this is a fake out.
The biggest thing is that we just have the highest amount of open options interest since 2021, right? And what was the market doing in 2021? It was one, it was a bull market, and two, the price was moving in wild directions. And like I said before, I think you can look at the options market and find footprints. I mean, I find it unlikely that institutions and people that are trading options in this high volumes would be on the wrong side of it. And everybody's kind of bought in volatility at the top, like it hasn't even we haven't really seen a retail effect in options markets in crypto specifically, right? Like Robinhood in 2020 and 2021, there was that retail mania of options traders. That's not really a thing in crypto due to many reasons, but it's just not, right? It's mostly
Mhm.
an institutional game here. So I find it unlikely that they're all aping into volatility at what would be the top here. It could be, but I don't think that's a likely outcome. I think it's more likely that we're in a new regime of high volatility here.
Okay, and yeah, as you're saying, this is more of you're saying this is more of the smart money that's coming in and getting into more vol.
Yep. Yeah, it's
Okay,
typically it's mostly hedge funds and different institutions trading BTC
right.
contracts.
Okay. I want to ask a question related to what Ben was sharing, which was that as we start to see a regime change happening as we go into 2024, the Fed starts to step back a little bit, allowing the market and their assets to become less correlated, find their own clearing price. What's your perspective on how that would impact what you just shared here in terms of volatility? Is it just another catalyst that's going to continue to push it up? Are you really not paying attention to that because the data on the charts gives you enough information to trade? How do you think about that?
It's just more liquidity, right? And I think that may be ultimately what we see the options markets front running is if you're in kind of these positions where you're managing a lot of money, you have the inside track, that sort of information. You know when conditions are going to ease, you do a lot of research into it. So what's the best way to make a trade? And a lot of these funds are pegged to Bitcoin, right? So they need to outpace Bitcoin. How do you outpace Bitcoin if you think it's going to go up? You can't just own Bitcoin. You'll just be matching your benchmarks. So the way you do that is by speculating on options. And that allows you to juice your returns further, right? So now you can outpace the benchmark. You can hedge yourself in different ways. And I think that's what we're seeing now is kind of the front running of the eventual future wave of liquidity that will come, which Ben touched on.
Okay. Well, very interesting information. Anything to add before we move on?
No, that's all.
Okay. All right. Well, thanks, JJ. Interesting footprints, as we're saying. We're starting to see the Sasquatch make its mark on the markets, being felt in the way that options and perps are being reflected here. And you obviously see market participants get into more volatility. We're going to be talking about stable coins in a little bit and what that, which is another fingerprint, if you will, or movement by the Sasquatch that we can look at. But before we do that, we're going to bring on Ray, who has been talking about the fact we're in a bull market for a very long time. He may come on this episode and actually say the regime change already happened, guys. But I want to hear from you, Ray. What is it that you've been looking at? You, I just said, you've been calling this regime change for a long time. I think as we're talking about it today, what is it that you looked at before, and what do you continue to study to continue to suggest that we stay in a bull market?
A good intro. Thanks for lining that up for me. I think that, like in real life, a regime change is multifaceted. So when you have a revolution or a change of hands or a change of, political players, it's many different things that are happening in tandem or separately, which eventually lead to the coup d'état or the explosive event that makes the news that everyone then focuses on and begins to unpack. So I agree with you. I think multiple regime changes have already happened. But what happened in the last 2 weeks is we saw traders start skipping the steps by threes. Instead of taking one step at a time, if you're trying to get somewhere quickly, you might start to pole vault steps by 2, 3, 4 at a time in order to kind of reach that paramount or that apex quicker. So yes, about 5 months ago, I went on the record as saying that we are in a bull market, at least for Bitcoin. Personal confirmation of this for me was not based on the technical definition of price pushing above the previous all-time high at 69.8K, but more so the box ticking of historical patterns, which in previous market cycles have proven to be generational buying opportunities. So some very basic indicators for me were that the weekly RSI fell below 30, as low as 24 in July of 2022 and November 2022. That's something that has only happened 3 times in Bitcoin's price history. When you look at the RSI on the weekly time frame, the price breaking multiple standard deviations away from its normal range let me know that an eventual snapback would occur, which is another buy signal. On-chain data and deep selling from all cohorts of short and long-term Bitcoin wallets or holders was also a sign. And the MACD on the weekly falling to its lowest level ever was kind of another sign for me that it was time to start accumulating in Bitcoin. Those were all kind of signs of a regime change of investor fear beginning to shift into greed or into an accumulative kind of phase. So,
Right. Yeah. And I wanted to add, on several of the episodes, you said those exact words. You said this is a generational buying opportunity. So as you said, that the confluence of all of those metrics or indicators suggest that this was a really good time to buy. So tell me now, as you're looking at this, you're talking about traders moving forward. What's your perspective on, what the next couple of months, next 6 to 9 months looks like, and continuing? What do you continue to look at? Is it the same set of metrics, or are you starting to expand out and look at some other stuff? Because I know you shared some data here with the producers.
Yeah, the same metrics and more. So standard things that I know that JJ is also using are like the Guppy multiple moving average, the whole moving suite, a cross or convergence between the 50 and 200-day moving average. All those things kind of give you more confluence on whether or not it's time to start adding to a Bitcoin position. I think sentiment has played a huge role in the current regime change. If we're talking about what has changed in the last 2 weeks, I believe that we saw a positive increase in investor sentiment translating into action, that action being inflows into the market and a sustained boost in spot purchasing volumes. So I think that was the most recent sentiment change, which you could say is like an just furthering of that kind of regime change. But actually, I have a caveat.
Yeah, well, I want to ask drill down on that just for a second here. We talked a little bit about the correlation at the beginning of the show. Ben was mentioning how these assets will begin to become less correlated over time. And you just talked about the sentiment changing. I think in traditional markets, equities, as well as crypto, there's been this notion of we're waiting for another shoe to drop. You just mentioned sentiment has just changed. Do you think it's broader than crypto, or is it really unique to this, where we're finally starting to see, perhaps because the options market and the big players are coming in there, there's just starting to have a little bit more momentum and a little bit more enthusiasm just within our little part of the world?
I think it depends on an investor's methodology for how they build their rationale for investment. So it can be as complex or as simple as you want it to be. It depends on how much data do you need to help you confirm your thesis. So if looking at macro factors helps you shape your outcome on, Bitcoin's about to moon, that's fine. But if just looking at crypto specific factors also help you reach that endpoint, it's fine. So I'm not dodging the question, but I think like for the sake of time, can't really like go into all of that.
Into all of that. Okay. Well, I want you to come back because you mentioned that there was a caveat that you wanted to share for the audience. And for those longtime listeners, you'll know that we like to present a lot of different perspectives. And for those who are brand new, that's one thing you're always going to get here is some of the caveats, because we're definitely not the people that are going to be in Planet Bull Run all the time, or Planet Bear, if you will. Ray, what's the caveat that you want to share with the audience?
Well, the market participants took the stairs up to the next floor, which is good. They kind of escalated their pace of activity within this market. We broke that kind of record long low volatility phase, and the market is now jumping around. We see the altcoin market cap doing well. We see Bitcoin's dominance beginning to kind of pull back a little bit. We're seeing many altcoins that have put up 100% gains. So there's more flow in the market. We're seeing institutional flows begin to uptick again. I mean, open interest just hit a 19-month high. That's all great and wonderful. But I think some of us as market participants are tired or exhausted or highly levered, and everyone needs to take a break. And that translates to consolidation. So beyond the OI flush that just happened before we started this show, I think that the current weakness and the loss of bullish momentum in the spot markets suggests that downside liquidity is more likely to be explored than the much discussed gamma move to 41K happening first. So liquidity map data from Kingfisher, Glassnode, the volume profile visible range indicator on the Bitcoin daily and weekly time frame also highlight this. So I think JJ and I have a differing view with aggregate OI, so reaching kind of like a year-to-date high. That raises an eyebrow for me from a trend sustainability point of view. I do agree with JJ that as we get closer to a bull market, as we officially enter a bull market, sure, we're going to see CME futures interest and just like aggregate OI across the entire crypto space go up as people hedge or begin to go long, so on and so forth. But within this current kind of time frame and isolation, I see the consistent surges in spot volume. What I would like to see is a consistent surge in spot volume aligned with institutional inflow, or I think we bust. I think the market reaches a place of exhaustion where, you know, an OI peak is usually a sign that people have become greedy or too risky, and those things usually blow out. So this whole trend of perpetual futures volumes outpacing spot volumes in the crypto market, that concerns me. I would rather see a lot more spot purchasing than just people using leverage to you know, push price higher. And what we've seen just a few minutes ago is that a certain cohort got liquidated, right?
Right. Yeah, no, I think those are good cautions on the near term. I do want to come back and just at least have a little bit more discussion on sentiment, especially if we look for a regime change going longer terms. But I hear Ben sitting on the sidelines waiting to jump in. At least I think it was Ben. Hopefully I know your voice. Yeah.
Just a quick question, because, you know, this is like a term that we hear a lot in crypto. And I think in the last cycle, the phrase institutional investor turned out to be DCG, Genesis, 3AC, Alameda, kind of all just moving money around and helping each other to take out more money. But you mentioned institutional flows, and I'm just curious, kind of like, what is, like, in your mind, what's your reference point that it's an institutional flow? And then what would you define as institutional, Ray?
That's a good question. And I think I could concede to you that you're right. If I'm looking at coin shares or coin metrics and their institutional flow, it's either into ETPs or it's VC funding or it's how much money did projects raise. I don't think that the institutional flow of like BlackRock, Fidelity, so on and so forth, Vanguard, them making their presence seen and broadcasting it within the crypto space has occurred yet. So I would say that perhaps that indicator can be critiqued.
I'm guilty of it too. And I ask that question a lot, and it's because, like, what is an institutional investor in crypto? Is it, you know, a trade desk that has become kind of like a brand name within crypto Twitter? Is it kind of the legacy Wall Street entities? Is it, you know, that's just a big question mark to me. And I always wonder, like, even in the options, like, I would expect institutions to essentially dominate that area more so than anywhere else, just because of like how options are used and employed within various strategies. That tends to bode well for more of a institutional setup where they probably have SEC disclosures and they have to go ahead and file all this paperwork on a quarterly cadence for all their investors, like that. You know, maybe that would be an institutional investor perhaps, but, you know, that's just one of those phrasings I always like to unpack a little bit and to find some nuggets.
Yeah, I agree. Looking beyond the actual metric or this bar on a chart would be part of the diligence of an investor to really define what is that flow, where is it coming from. But I also guess from a bird's eye point of view, if we're seeing like a prolonged boost in spot purchasing for Ethereum or for Bitcoin, and at the same time, you know, even from a like non-confirmed observation, we're seeing what we assume to be institutional investment in the space also peak. then that would be a positive if price follows along with that.
Yeah, I think that makes sense to me. Ben, I would say if we just had a liquidity map, wouldn't it just have all the players on that map?
If we had a liquidity map.
It's a bit of an inside joke. We go back and forth on our Discord about creating liquidity maps, and he comes back to me with a couple of charts because it should be so obvious, but obviously it's not. Definitions absolutely do matter, and I would imagine over time we'll get a better sense of what those look like, right, in terms of the actual definition for the institution. Unless there's something else on that, Ray, I did want to come back and ask you a last question relative to sentiment. Let's say that your scenario does play out in the next 3 to 4 months. We see some return back to a lower level, perhaps in the high 20s, low 30s range. How do you expect sentiment? If we are talking about sentiment being a regime change, do you expect it to be durable enough for people to say, "Hey, this is buy the dip," or are you looking for them to say, "No, we got faked out with this latest move up to 35 and above"?
I think it's dip buying season. That's the narrative. With price, like if price is going to explore the liquidity on the downside, it's going to be in the short term. So that would be like the 30K level, maybe to 27K. It's highly likely that people are going to pile into that and add leverage, and you'll see a lot of spot accumulation. And then we'll resume the attack on 36K, chase after that 41K gamma squeeze if that dynamic still exists. And I think the goal for most everyone on this team is to see price, in the event that there's no ETF approval before the end of the year, see price gravitate around the like 45K, 48K, 55K level. We'd be happy to see the year close, even with Bitcoin at 45K. That would be nice. Conviction of current sentiment regime changing is that the Bitcoin accumulation trend score has been blue since very early October of 2023. So it's a on-chain metric that one of our data competitors uses, and it just shows distribution and accumulation patterns among all the different cohorts of market participants. And in this instant, all cohorts, that's from 1 Bitcoin all the way to entities holding above 10,000 Bitcoin. In this instance, it's almost unprecedented. Since October of 2023, the entire chart is blue, showing that people, investors are accumulating Bitcoin. They've been accumulating since Bitcoin was range bound.
Okay.
Let's see.
That's something
like
we were talking about earlier in the year too.
26K all the way to
whale wallets
35K.
We're buying all summer. Remember, we're like, these people must know something because they just kept buying. Like every day we would check that chart and just see whale wallets up, whale wallets up, whale wallets
But
up.
I think, the metrics are there, so the news can be misleading, and the day-to-day price action can also, kind of dissolve your confidence. But all the higher kind of time frame, weekly and monthly indicators, all of them, whether they be for beyond network growth and network activity and new wallet creations, right? We can kind of cast those aside, but all the other metrics of whether or not one should be dollar cost averaging into Bitcoin on the higher time frame have all been kind of screaming, now is the time. It's just about what is your risk? How does your risk translate to what percentage of portfolio do you deploy? So I think the Bitcoin accumulation trend score really highlights the headline of the show, which is, has a regime change happened? And is it time for urgency? And we can see that, yes, sentiment changed, and people have become very urgent and active since October of 2023 because the entire accumulation trend score chart is blue from top to bottom in all cohorts, and that is unique.
Okay. So I think that puts the pin in the notion of sentiment changing, and Ray just laying out the case for what that looks like over the next couple of months. And I imagine as we start to see more momentum, if we're up at the 45 at the end of the year or even the beginning of 2024, I think you're just going to solidify that sentiment, which goes back into the regime change that we're talking about, be it that the Fed is going to take the reins off and allow Bitcoin to run. We see option traders starting to come in, and maybe some of that's more institution. Maybe it's, maybe it's neo institution. Then of course we have the sentiment that Ray just talked about. But there's another fingerprint that we need to cover. And for that, we're going to turn to our last guest here, which is Cody. He likes to stay quiet until he's ready to unload with his alpha. You, Cody, oftentimes bring up the data around stablecoins, because I know that you talk about the fact that that just has such strong product market fit. So tell us, from a regime change perspective, what are we looking at here? What do the stablecoins tell us?
Yeah, so stablecoins all through the bull market were increasing like rapidly. We saw like, I don't know, stables were at like, I don't know, 1-2 billion in like 2018, 2019. And it went all the way up to almost 190 billion at the top of the bull market. And then, yeah, that peak was around April or May 2022. What happened then? Luna crashed. And ever since then, we've seen a like outflow.
Hey, Cody, you're a little faint. Yeah, just get just a bit closer to the mic.
Yeah. So we've seen a continuous outflow of stablecoins. Obviously, the Luna drop caused like a massive drop in almost no time for stablecoins to like 160 billion. But ever since then, people have been cashing out their chips out of the market, mostly through USDC. So we've seen the market cap of USDC go down significantly from like 40 billion at the peak to like 20 billion now. But also like BUSD, they had some issues with regulators. That's next to nil now. DAI also at the peak was like 10 billion, and then it also came down. But ever since August, that's like 2 months ago now. No, 3. Sorry. So
well, Cody, apologize for I just want to cut in here because I think you have a chart here. Producers, could we bring that up on the screen? Because I think that would be helpful to walk through for our audience.
Mm-hmm. Actually, this chart is not the total stable coin market cap. It's the one for Ethereum. But since most stablecoins reside on Ethereum, it still paints a similar picture. You do not see the drop in USD. That would be, as I said, around April, May 2022. What you see is this constant outflow, mainly from USDC. Starting again in 2022 and basically until now, what you would see in the total stable market cap chart, and I apologize for not having that right now. We had some issues, but yeah, what you would see is instead of this dip down on the last few months, it actually stabilizes and like slightly going up. Like it, but you need to really zoom into the chart to see that. But it is good to see that the market cap is not going down. So that would point to people not wanting to cash out of market and actually being interested in like or thinking that the pie is going to grow in the months to come. And what we want to see in the future is for that line to start picking up again. So if we start seeing new highs in the market cap of all stables, that would point to like a very risk-on environment yet again.
That's especially bullish for DeFi, right? Like you think of all the like TVL numbers and whatnot. USDC is basically the fuel behind that. So
yeah, absolutely. Like we've seen TVL like go down significantly for all major chains. So this could point to TVL starting up, and it will also have an impact on majors. What's that?
Ponzi season back on. When you see the
Ponzi season back on, but it will also have an impact on majors, right? Because like it points to more liquidity being added to the market, more dollars trying to chase risk. So I think it's positive for everyone, basically, like majors all the way to your Ponziest small coin.
And just for those new listeners, we don't really try and pump the Ponzi's, but we do acknowledge their place in the market and the fact that they seem to play an outsized role that maybe we wouldn't even like to see. So I guess, Cody, I want to ask you sort of similar questions I asked JJ, Ray, and Ben. You just heard their view on what suggests that we're in a new regime change. You just put it down from a stablecoin perspective. If rather, as you start to see some of these actions play out, from the Fed starting to step away, from the options market starting to pick up steam, perhaps with new market participants with deeper pockets, as well as you start to see the sentiment that Ray was talking about start to pick up into next year. What's your perspective on the stablecoin? You just mentioned you want to see it to start to pick up. Are you expecting it to do more of a hockey stick? Are you expecting it to be a slower movement? How are you interpreting that?
Slow at the beginning and then rapid as people chase risk. I think now, like we've seen it stabilize for what, 3 or 4 months now, and then it will still start ticking up slowly, and at some point it will be like a dam that is open, right? I think that's what you're gonna see. But again, like this is just a prediction. You shouldn't really listen to me that much on this because I cannot see the future, unfortunately.
No,
But yeah, I think
absolutely.
all of these, what everyone has pitched in, and stablecoins as well, points to the idea that like the regime changed. It changed a few months ago. It's still changing, but it's pointing in one direction, and that's up.
Okay. All right. Well, I know this is pretty brief, but is there anything else from a stablecoin perspective that you want to share with the audience?
I would be on the lookout for new stable, maybe based on LSD, getting some getting to like a 1 billion market cap or something. I think that's the kind of like the threshold at which a stable becomes useful. Or so I don't know. Like I would like to see more players in the stablecoin arena. Right now, DAI is useful, but like it has grown up lately only because it offers yield. But the only 2 stablecoins that are useful in DeFi and trading are USDT and USDC. Both are very centralized, and I would like to see a decentralized option, but yeah, it might not happen.
Okay. Well, yeah. So what you want to see versus what the market will
Yeah.
bear. Especially, I would imagine you're tracking, or at least you're aware of the legislation that's going on in various areas. I think I saw something just this last week about something coming out, maybe perhaps from England, what they were doing for stables. I think Europe is looking at its own legislation. So I imagine there's going to be more competition for stables coming from non-traditional sources going into next year and beyond.
Yeah, maybe we see like a government backed stablecoin that actually takes DeFi by storm, let's say, and everyone starts trusting that more so than USDC and USD. I don't know if it's going to happen, but yeah, that might be the case as well.
Or JPM coin.
Yep. And that is for the audience who's new here, or maybe missed that video. We've talked about that in the past. Sort of the legacy institutions being able to bring to bear their knowledge of traditional assets, combine that with what they're learning about crypto and the infrastructure. And I think, Ben, you've written a few different articles on that, if I'm not mistaken.
Yeah, I mean, they're just putting out, hundreds of pages of papers now talking about deposit tokens, which is really just issuing a token, which is a stable coin, against the collateral held in custody by the bank itself. And what are those assets? Treasury is right up there. I would expect mortgage-backed securities to creep on up there as well. And so you're just issuing a stable coin because somebody wants to withdraw $1 from their checking account, but you don't actually have to sell the collateral. It almost makes too much sense for them not to do it, and they're already headed in that direction. So to Cody's point, like I could see once they decide to finally go across the Rubicon here and come onto an open network like Ethereum, like it's going to have a lot of adoption quick.
Talk about a real material part of the regime change. All right. Well, I think that's going to do it for this week's episode. And I want to thank Ray, JJ, Ben, and Cody for joining us. For those who are new listeners, I hope you got something out of this. We'd love to hear your perspective on the regime change. Let us know if you think that we're missing the mark on some of the signals that we're looking at, or perhaps you want to know more about some of the signals. You have better questions about than I asked about any of the indicators that these 4 guys were talking about today. I think it's clear, though, to anybody who's listening and anybody who's a market participant, we're early enough in the regime change that we're part of that starting group, right? It's not at the middle of the market where everything has gone into some kind of hyperbolic frenzy. No, this is the beginning part. Still a great time to be thinking about your investment strategy. And if you're still trying to ask yourself where you need to be invested, we've got many channels, many videos on the channel that are going into our perspective on Bitcoin and altcoins. So there's a lot to check out. I suggest you find some of those videos. But for that's going to wrap it up with this week. This is Marconi White signing off.